Today, international banker is joined by Dr. Charles Kimei, Chief Executive of CRDB Bank plc, to discuss both the bank's success and the future of banking in the Tanzanian market. Charles, very good to have you with us today.
Thank you very much, Simon.
So, how would you characterize Tanzania's banking industry? Do you expect the sector to undergo any consolidation in the future?
Yes, thank you. I would say that the Tanzanian banking industry has grown tremendously in the past few years, with the number of institutions rising from one in mid-1990s to 59 as I'm speaking of today. Of course, the real commercial banks are 44. The others are non-bank financial institutions. But 59 financial institutions in a country like Tanzania is large. Now, I would say that despite the number being large, some of the banks are very small. They are community banks, and they are more niche-oriented in the sense that they focus on certain segments only. And very few institutions, I think only 5 institutions have national-wide networks. And I would say that we have international banks, which are also operating quite well, but I would say that they are more restricting their operations in the big cities and big towns. We have about 4 big towns. They are Arusha, Mwanza, Dar es Salaam itself, and Mbeya. And that's where they are. So the degree of competition becomes very narrow, so to speak, because the real competitors are those which have the national networks, which are 2 banks. I could say 3. The My Bank, which is CRDB Bank, is now dominating in terms of the network, if you include all the outlets that we have. Then it's followed by a national bank, National Microfinance Bank, and then National Bank of Commerce. These 2, which are now following us, were the biggest before. And I would say that the smaller institutions are quite vulnerable in terms of changes in the operating environment, especially as the central bank tightens regulatory requirements, capital requirements for that matter. Now they're introducing operational risk buffers. And I think given the difficulty of growing their own capital, because they are not very, very profitable, only the large ones are more profitable. They cannot raise capital internationally or domestically. So the smaller banks will be forced somehow to go into acquisitions or megas. Otherwise, they will not be able to survive the regulatory environment. It's very much following the international standards, and really the only banks that will be able to survive are those which have wider networks and which are large in terms of capital bases as well as funding diversification.
And talking of performance, last year saw some startlingly big numbers being posted, such as 21% growth in profit before tax and about 35% growth in the group's net income and margins. How well positioned would you say CRDB is to maintain such growth rates going forward?
Over the last 20 years, we are now celebrating our 20th anniversary. The vision of the bank has been to grow its network in terms of outlets. We have focused on retail banking, and retail banking means that going to the people. And you see, Tanzania is not a country of big companies. So far, it's dominated by a small, medium, and if you want to grow a bank, really you have to go to the bottom of the pyramid. That's why we said, okay, we want to grow a retail bank, and for us to do that, we need to expand. So the growth has been phenomenal in terms of the branches we opened in a year. Last year, we opened 76 branches in 1 year. We started with 19 branches, but just last year, we opened 76 branches, apart from other outlets that are below branch category, like service centers, mini service centers, agents, etc. So the idea has been to really grow. And when you grow, you cannot make much profit because you trade off between growth and profitability. If today I was to stabilize, say that I'm not opening branches and I'm not going to Burundi and elsewhere, for sure I can double my profit. But we have said no. Our vision is to build a foundation. And I can tell you that the foundation which that were built for the last 20 years is now starting to yield fruits. That's why you see that even though we have been posting around 20% of profit growth over many years, but now I can assure you that what we posted last year is a peanut, because we know that with the maturity of our foundation, the outlets that we have put in place, and the new products and platforms, the systems, we have improved our core banking system and the supporting peripherals. I'm sure that we have now reached a stage where we can say we've built a critical mass to ensure sustainable growth in our profit for many years to come. And what we want to say is that as we stabilize now, because we are now focusing on consolidation of those achievements, I'm sure we should be able to post a larger profit.
But within that performance, though, there was a kind of non-performing loan ratio of 8.1%, which is perhaps higher than you'd like it to be. How do you intend to reduce this number going forward? And
actually, the NPL, which grew a little bit last year, more than what we have targeted of between 5 and 7%, is what actually reduced a little bit our profit. But I can tell you that there are three main reasons for the increase in the NPL. First, it is to do with the change in regulatory provisioning. From last year, the central bank introduced a new prudential regulation that requires that once you restructure a facility, even though qualitatively that facility is good, you cannot upgrade it until after the 4 consecutive installments have been paid. So we had to maintain a poor classification of some of the facilities that we had to restructure, but which qualitatively we know they are good facilities. And so under the previous prudential regime, we would have left it would not have affected our provision. So that is one. Second, there was a problem with government interference in the tobacco trading in 2014, 2015, which made some of the borrowers, which enabled some of the farmers to divert sales of the tobacco through sales to independent farmers, thereby bypassing the channel through which they should have been deducted the payments for their loans, which is the agricultural marketing cooperatives. And then the third one is the sugar. With the sugar industry, which we are also financing in a large way, there was a problem of dumping sugar into the country. There was a huge imports. And so the sugar factories, which had a large exposure from us, were not able to fulfill their obligation to the bank. That's why we saw that increase. But all these three factors have been addressed by the new government. We have a new government which is focusing on industrialization, and it means that they want to ensure that the local industry is performing. And for that matter, they have now addressed the issue of unnecessary imports when local industry can actually meet the demand. And they have addressed the issues relating to the tobacco and the issues addressing to the issue with the regulation. That one is once and for all because we have addressed it. So I think that we should be able to reduce the NPL ratio beginning the next year.
And in talking about that, you're describing types of clients that you service. You actually kind of cover the entire spectrum from microfinance through to retail lending, all the way up to major corporates. How challenging is it for the bank to have that kind of diverse loan portfolio?
Yeah, I think as you see it, a lot of people who are looking at our portfolio, they tend to think that we are really looking at a very diverse portfolio. The real issue is that the corporates you are seeing in our portfolio, they are SMEs who have grown with us from small, medium, and now they've become corporates. And you wouldn't want to grow a customer from SME and then later on let them go into another bank. So that's why we said, okay, we will create our own corporates, because the corporate segment in Tanzania is not a large one. And when we started about 20 years ago, the corporate segment was being dominated by international banks, and they were fighting there. The competition was tremendous. And of course, the definition of a corporate in our case may be a small enterprise in Europe. So we started like that, and we said, okay, we should create a funnel from the bottom of the pyramid, you will be able to siphon SMEs and ultimately get corporates. And this is what You see, that's why you see the portfolio is diversified with all the segments. But the segments, you say, we've grown. They are customers of the bank who have been graduated. They are graduates of small and some of them micro. We had to create a subsidiary company called CRDB Microfinance Services Company because we could not create a microfinance bank at the time we wanted, that year 2000. So we created that to help us manage the bottom of the pyramid, the micro entrepreneurs and the small informal groups. So with that one, we were able now to get the customers into retail. Because some of the customers who are individuals graduated into, qualified to become onboarded as retail customers. And some of them, as they stayed there in that area for some time, they graduated into SME, and ultimately some of them are now graduating to corporates. So what I'm saying is that really we have performed a strategy that somehow is uplifting everybody. And that as a national, and maybe it's now the only local institution that is run by locals there. We know the requirements of our customers. Mm-hmm. And I'm glad that really we have been able to graduate people and then scale them up into becoming good customers.
So SMEs constitute a massive percentage of the total number of businesses in Tanzania. Do you think you're currently satisfying the kind of exposure that you have to that sector?
We are to some extent. Of course, you cannot chew too much at a time. But what I can tell you is that about 65% of the SMEs are not accessing any bank financing. Mm-hmm. And some of them cannot access because they don't have the traditional requirements for a formal bank to lend to them. And most of the time, the SMEs may be just depositors, but they will not be accessing the finance. So they are not getting the benefit. So what we did in year 2006 was to create a special program that re-engineered the process of looking and appraising facilities to these customers who have been in the core of our deposits, inviting them for capacity building, showing them that they can grow their businesses and then they can become better in terms of increasing their scale of production, the profitability and all that. So with that program, we've been able to accommodate non-traditional collaterals. Like, for example, movable assets, we've accommodated even customary titles into the collateral arrangement so that they can get access to finance and therefore be able to acquire the assets they need for them to increase their production. So that has been the approach. And I'm glad that a number of multilateral institutions like IFC, DEG, European Investment Bank, and the African Development Bank, in collaboration with USAID, they have supported this program because they saw that it is one way actually of helping out the growth of the country. Mm-hmm. And we have been able now to, as we go forward, this system is working, the appraisal and the management of this segment is very much robust in the bank. We're even thinking of creating a special department just to handle this. And the 65, if we are able to pull a few percentage points of that 65 who are not accessing any bank financing, I'm sure it is going to contribute tremendously to the growth of the economy and to the growth of the bank. Actually, we are saying that the growth of the bank in the coming decade, and maybe for many other years, is going to come from SMEs. That's where we are focusing. We've been able to reduce the exposures to corporate segment, and we've now, in the last 2 years, we've been, even the issue of NPL, we know that what has caused a lot of problems is the corporate segment because of the exposure, and they've become very vulnerable because they are vulnerable to external shocks. But if we focus on SMEs and retail, the exposures will not be large, and that will help us also manage down the NPL. That has been our focus.
So, and that kind of nurturing of your clients is equally matched by nurturing local talent as an employee and management levels. How important is it to you that your staff are predominantly Tanzanian, that you're growing local talent and local ability?
Yeah, we really pride ourselves to be a local bank with a good, strong international content. Not that we really just want to grow the local talent, but we know that we have an obligation to grow the local talent in banking, because the Tanzanian market doesn't have skilled bankers. So we have to create them, and we create them by giving them an opportunity to start working at the bank before they even finish their college education. We bring them in as practicants. They do their practicals in the bank, and they go through various processes in the bank. And then gradually, once they are about to finish, we bring them as interns. They work with us, and we identify the best ones, and we keep them. We give them contracts and then full employment after a year of internships. But what we do is that we have to develop them professionally, and we are collaborating with the international business schools. We are collaborating with, especially South African distance learning institutions like Millpark, and it used to be Damelon School of Business. We are working with them to ensure that they get the right skills and the right exposures. We are giving them exposures also outside the country, especially those who are going to leadership positions, because we want to create our own MDs, our own CEOs to come in the future. I'm about to leave the bank. I will have to leave the bank sooner or later. But we do also in-country training programs within the bank. We have a very strong, and we are now going through accreditation programs. There's a Malaysian company, a Malaysian academic institution, Academy, which will be accrediting our training programs, in-house training programs. But I can tell you we have distance learning program and e-learning. And this is sometimes compulsory to every staff must be doing one particular training at any particular time, so that over time we accredit them and they get certified.
And now another achievement in terms of not just nurturing staff is you've achieved your goal of 5% market share 2 years ahead of time. And I'm talking about the performance of your Burundi operation. And what has been the biggest factors underpinning this rapid rate of development there?
Yep, I can say that with the Burundi subsidiary has been able to achieve its targets within a very difficult operating environment. When we went there, the situation was calm, and it looked to be calm, but unfortunately, just a year, 2 years in pipeline, the whole thing erupted into a political chaos. But it's not, now as you can see, things are stabilizing in Burundi. And I think with the help of international community and the regional authorities there, things are coming to normal. But you can see what we did there was the strategy. One strategy was that, and one thing which helped the strategy was that the Burundians accepted us very well. They accepted the bank and they opened accounts in a way which we did not even think about. I think some of them, they have a lot of affiliation, because what we do when we are opening a subsidiary, a cross-border, and even now we are thinking of Congo and other places, we are following our customers. So we have customers who are Burundians or Tanzanians who were actually already enjoying the services. So we followed them. But the second thing was that we offered products and services that were different. We targeted customer service as the major offering, that we could operate our branches at the times when others were closing. During lunchtime, when others are closing, we continue to offer our services. And we opened 3 outlets in Bujumbura. We were planning to open more in the third year. There were almost 4 another 4 in other upcountry stations, which were already in pipeline, but unfortunately when the situation changed, we had to change with it. But lastly, the other thing which gave us an advantage was the fact that really we are targeting digital channels. For example, right now what we are saying, although we cannot go and start opening brick and mortar, but we are using now the digital channel. Internet banking, SIM bank, there's something called SIM bank, which is the mobile platform which is rests on mobile telephones. So with that, we're able to attract customers or even when there is a war, there's no war, but when there is a lot of uncertainty, people still can tap on their accounts and so they are opening accounts. That's why I think that much as the situation looks a little bit not very conducive, but still we're able to continue maintaining our profitability there. And of course, we've tried to reduce a lot of costs so that we are able to continue making money.
Now, earlier on, you talked about the kind of microfinance work that you've done, and you're in the process of turning that subsidiary into a standalone bank. What benefits will such a move reap, do you think, for the group?
A big one. First of all, we should say that the culture of a microfinance operation, a microfinance bank, should be different from a traditional banking culture. So by hosting it within our own, the parent bank, which is a traditional bank largely, then we are failing to manage it in a cost structure that will justify more profits out of it. For example, in a microfinance operation, you expect people to use motorcycles instead of cars and such as even bicycles to go and visit, and then the rigorous follow-up of loans and creating volumes. But when you are working within a traditional bank, this tends to be a little bit, it puts a brake on those because they tend to think themselves as bankers, normal bankers. So we have always wanted to have this operation outside as an independent operation. Unfortunately, it was not possible because of the regulator did not give us that opportunity when we wanted to register a separate bank. And now they have allowed, and they think that that was a wrong decision at that time. So now we should be able to hive it off and run it so that it can create its own working platforms. One thing which will give us a big advantage that now they can run more informal outlets, but digitally powered. We are giving them an M-wallet operation, which means that they can actually onboard customers much more easier and much more safely, and in line with a risk-based approach to customer care, know your customer requirements. So they will be able to run that. Now, we will also give them an opportunity to continue to work with our branch network so that they can add value and they can graduate customers from their the bottom of the pyramid, as I was saying, back to the retail and reach our retail. They can also help us know exactly where we should locate new outlets and the sizing of the outlets, because the sizing is very important to manage the cost of the outlets. And I think once we know that they have created a base of micro entrepreneur, micro operation somewhere, and the requirement is now for us to step in with a branch or with a mini center or a service outlet, then we will go in. And then we know that you break even almost within 6 months. As you come, because you already have a customer base, and the synergies will be working. We have a mobile branch or a branch on the wheels, which is the trucks. They have theirs and we have ours. Now they can be able to work and connect the ecosystems so that the customers will be integrated. That any customer from that side can work with the bank and benefit the benefits of the integration of our delivery, especially the alternative banking channels.
And within that, all the various ecosystems you're running effectively, one of the ones obviously is kind of the telephone-based online banking, yes. The impact of digital. Yeah. Now, your fast account opening mobile app enables a customer to get a bank account up and running in about 5 minutes and without the need to visit a physical bank branch. Really exciting new product. How important is it to you that the bank is able to offer innovative banking products?
Yeah, I think this is something, again, we are very much proud of. With this fast account opening, we have been able to run our urgent banking operation. Urgent banking is, there are agents who can actually open accounts and who can offer similar teller, normal teller services to customers anywhere. Now, without the fast account opening, the agents could not open accounts at the speed we wanted. It means that they have to find a network, although they are linked to our system. But this fast account opening gives them very easy way to communicate, to get the KYC, and then to transmit automatically. Once we press a button, we get the account open, activated in the account, where they have already issued a card, a bank card, to the customer at the time they have just onboarded the same. So it has given, one thing is that we are now able to increase our customer base. And you see the profitability of the bank, which you talked about, will gradually be dependent on non-funded income. Non-funded income will come from volumes of customers who access our network, our delivery channels, whether alternative or the traditional ones, and transact. And each transaction has a fee, small fee, maybe a small fee, but with large volumes, then that's where you make money. So with the tightening of the financial market, that interest rates margins, now where the average net interest margin is about 10%. You cannot rely on that forever. It is going to come down to something like no more, 6-5%. So what can compensate for that, the reduction of net interest income, will be the income, the non-funded income, which is the transaction fee income and other commission income. And I think the best, and the only way you can assure that is to have the volumes, the customers. You must board customers into our systems, and they must feel very safe and very comfortable and convenient to do transactions, whether the traditional banking, that is withdrawal, deposits, but also make payments, payments to utilities, make payments to anywhere they want, even pay TVs. They can. Yeah. All that is available in the menu of our offering. So they can actually sit in their houses. And these people, some of these people who don't want to go to a branch because they think that a branch is somewhere where only people with a tie would go. But with their network, with their mobile phone in their home, they are able to access that thing. So they will always make money for us.
Africa appears to be leading the global mobile banking revolution. Do you expect that sector to continue growing rapidly for some time? And if so, is it an area in which you intend to allocate a greater proportion of resources?
Yes, I think, and I think anyone would say that the future of Africa and the banking in Africa is going to continue to be redefined in terms of fintech. And any bank that will survive and continue to sustainably make money will have to invest heavily in digital systems. Not only digital, and make sure that really they are working reliably and the availability of the systems are good. And they say that in the digital era, you have to ensure that everything is not perfect, but is near perfect. Because you cannot test forever. So I think even for the bank, for the CRDB Bank, if we want to continue maintaining our leadership position, we will have to continuously invest in alternative banking channels, make them mainstream those, because the traditional banking, the way the old systems are working anywhere is not going to work in Africa. We have been able to leapfrog into fintech because we don't have legacy systems that will bog us down. Most of the European banks, for example, they are bogged down by legacy systems that, okay, I cannot dismantle that, it's expensive, there's not been But for us, we are now we have leapfrogged into a digital banking. And so in a way, we have to ensure that we sustain the leadership in that area. And this has been reinforced by the fact that with the mobile telephone operators coming with mobile money platforms, they disrupted us. And if we want to continue enjoying the benefits of banking, which is the payment system, the leaders of the payment system in our country, we really have to disrupt the mobile network operators. Because they don't have a monopoly over the payment system. We can always, and we have the benefits of managing money, the cash and so forth for the economy.
So fintech's enabling you to be much more agile in terms of developing
business. Yes, exactly.
But
exactly.
In a more traditional manner, though, you've established country-specific business desks for China and India. How's that going so far, and have they managed to meet their expectations to date?
Yes, I can tell you that one of the things that we are proud of, very much proud of, is the China desk. Now we had also India desk, and we have an evolving European desk somewhere in a locality where we have most of the European operations, where they live visually. Most of we have Oyster Bay area in that case. So it's evolving, and the Chinese one has taught us that it's always, there are cultural differences in terms of whom they can trust, especially the Asian population. They tend to have a very, very stringent, or rather well-prescribed cultural differences. And we thought that by putting in place a unit that can speak Mandarin, people can speak Mandarin, can speak the language, and then they know a little bit of the culture there. They can create the trust that we need from that community. You see, Chinese community in Tanzania has grown tremendously because a lot of the large contracts in infrastructure, in oil and gas, virtually they grow in sectors of our economy, have been dominated somehow by Chinese government institutions who are funding some of this. But of course, the Chinese traders have joined the bandwagon. And so we have a growing Chinese community, not so much, but it is growing, it is there. But also Tanzanians who find China an easier source of raw material, not of raw material, but of industrial goods and even some small tools. They're also going to, so they needed a bank that can connect them. And the same applies to that. So in a way, I think the China desk has been very much successful. We have almost catered services to, I can say 80% of the Chinese community, which is in Tanzania, is getting, either they are getting loans, huge loans, trade finance, they are getting most of the financial services from us. Despite the fact that people are saying Chinese economy is growing at a decelerating rate, but no one should expect the Chinese economy to grow the rate it has been growing forever. Because initially they had productivity gains to do at their infancy stage of catching up. Now they have almost caught up. So the rate of China growth cannot be expected at more than what is happening elsewhere in the world. So I think they will be coming down as they reach the saturation points of their productivity growth. And I don't think you will expect them to grow 10% anymore. You expect Tanzania to grow 10%, but not China, which has now almost exploited most of the productivity improvements that they needed to make for them to grow fast.
I mean, moving from the kind of, where China is and what its economy is doing, you've also initiated a comprehensive process review last year as a way to kind of improve your operational performance within the bank. What were some of the key learning points from that review?
Yes, I'm happy that we did introduce that, and we brought in KPMG. They looked at the operations. Actually, we wanted a third party to look at whether we were operating at the right standard. And we came to learn that centralization of some of the back office operations could give us a lot of mileage in terms of cost saving. And that's what we've done. So with about 200 branches, with each of them with back office operators, more than 7 people doing back office work, you could actually centralize. But also the service you get from a centralized operation is that it's more, it's a repetitive, and the people whom you put there, they tend to know the processes better. Rather than, we're employing almost 400 people every year. And some of these are new, so they tend to compromise on the process and control procedures. So in a way, we found that you can increase the quality, improve the quality by having a dedicated unit almost at the center with fewer people, doing it more professionally, more qualitatively better. And I think we are very happy. We have changed now the layouts of our branches. We now want the branch to focus more on the customer, because initially the branch will be almost bogged down with back office and forget that the customer is the key. We are working for the customer. So now a branch is a front office. They have to find the customer. They have to make sure the customer is happy when he comes into the branch. And efficiency is key. The speed is key.
Yeah, and you mentioned earlier the kind of number of branches that you've opened recently. How important would you say it's been for that expansion drive to access regions that have either been underbanked or unbanked altogether?
As I said, really, if we want to focus on non-funded income, and even then you want to reduce the cost of funding, the only way is to tap on small depositors. Small depositors are somewhere in the remote areas who have never been reached, and they are not really looking for interest rates. They are looking for somewhere, a safe haven for their savings. So we found out that when you go closer to the customer, we are getting huge deposits, unbelievable. Right now we have seen that the corporate deposits have almost dried up because the government has decided that the government corporations have to bank with the central bank. Will have to put their deposits in central. So they transferred huge amounts into the central bank. So it's a way of forcing banks to go and look for deposits where they are. Mm-hmm. And I think this has helped us to refocus. And I think it was just a blessing in disguise that we had opened those so many branches. But as I said, apart from those branches, we have also made sure that these branches have service centers, which are small, almost kiosk type outlets, and they are working for the branch. They are managed by the branch manager, but they have a supervisor. But they are located, because they are cost effective, they are very low cost, with about between 3 and 5 staff. Mm-hmm. So you are able to break even on these small outlets quickly. Mm. We also have put in the government service centers. Because of the local governments, they will need service close to their offices. We've put in those, but they're also saving locals. We've put in the mobile branches. But apart from that, the SIM banking, our own mobile branch, our own mobile platform, which is the telephone operation. All these are putting a lot of, they've somehow synergized, and they're helping us to reduce the cost of funding. They're helping us to increase the volumes of transactions that the bank can perform at any particular time. The issue which was a bottleneck was whether the system can absorb so many transactions. So what we did was to say that we have to upgrade our core system. We upgraded it. Now we have, I think, the best, not Tanzania, but I think the best in the world. Because it's a new system that is run by MISIS, and we have been running with MISIS for quite, since I came to the bank, about 20 years now. And they have been able to really revamp their system, such that it's a system that we are passing through. The throughput of the system is 200 transactions per second. Right. The ones which we had before we went live with this last May, it was taking only 2 transactions per second. Now you can see we improved them, but also we have made sure that we have the volumes already to go through. So I really think that is a blessing. The strategy has been working. The strategy is good, and much as we are going to rethink of a new one, but it's still.
You've mentioned 20 years, so you've had a long and illustrious career within the financial sector. How different is your current role as CEO and President of CRDB to your previous roles, for example, your time with the Bank of Tanzania?
I'm very glad that I left the central bank, because I've learned a lot of new things. I've learned to work with the private sector. At the central bank, you are a regulator. You're almost shielded from any risk, and any risk is almost falling to a taxpayer somehow. But when you work with the private sector, you know the requirements of business. And if you are sending me back to the central bank today, I think I will overhaul a lot of things to make them understand that one day delay in a decision is almost a year breakdown for a business. So there are many things that the central bank. I was a bank supervisor. I did the first set of regulations and so forth. Now, when you look at them, you find that some of them don't make much sense. For example, following the Basel standards, without challenging some of the requirements which Basel is putting around, it makes you think it's crazy, because the balance sheet of my bank is only, on one side is credit, the other side is deposits. So the risk I'm running is only credit risk mostly. I'm not running derivatives, credit swaps. That market is very narrow. As I said, it's still not very competitive area. So if you apply the same rules of banking as you apply in Europe, which is you have a book, various types of asset books. Some of the asset books are very, very far-fetched assets, because they are derivatives of derivatives and derivatives and swaps and swaps and swaps. Then you constrain the growth of the sector unnecessarily. Instead of looking at the real risk, which is the credit risk, and you prescribe rules that govern, that will give you enough buffer in case there are credit problems. You don't prescribe too much and then stifle the growth. Because for these systems in Europe, in the US, they've grown. They've become sophisticated because they were allowed to grow. Now, if you stifle the ones which are just evolving in Tanzania, in the rest of Africa, by rules which are applied to sophisticated systems, those systems will never grow. They will remain just a credit-driven financial systems. So it's high time people think more beyond what we, of course, the sophisticated bankers, they'll say, we want to compare apples, but you cannot compare a grown-up apple and an infant apple, because an infant apple would need to grow to give to yield the fruit. And now the way they are regulating us is almost making us not to bear any fruit, because how? You tell me already to provide for things that to provide capital for things that are not there in my book.
Yeah. One thing that has happened, though, is you recently received your first ratings from Moody's Investor Services, the first bank in Tanzania to do so.
The first institution, not only a bank,
first.
because we're the first institution there.
How big of an achievement do you consider this to be, and do you think it will have any bearing on how the bank is perceived globally?
Yeah, we went for the rating because we thought we needed it. We already have started to get to look for funding. For example, the SME, there are quite a lot of institutions that would want to offer SME facilities to banks in Africa, to banks in the emerging markets, because they know that that's where the growth is the world over. And that's where also you can make some rates, higher rates, because they are more profitable. The way they operate with low cost, they make more profit, so they are able to pay a higher interest rate. So we thought that to pave the way and to open it and to diversify the funding base, but not only funding base, also investor base, because we are a listed company. So we want our shares to become more liquid by people knowing what the bank is and getting interest to invest in the shares and all that. So we thought that we should get a rating. It will give comfort to those who come to do a due diligence, reduce the cost of due diligence, knowing that there is also someone who is watching the performance of the bank in terms of accountability, in terms of transparency of operation and corporate governance for that purpose. So we initiated that rating. We did not expect a very good rating, B1 stable, which is one of the best ratings that has been offered to institutions in that sub-Saharan Africa. Because, as you said, we had the NPA ratio had gone slightly up. But I think when you look at it, they know, anyone who looks at the bank will tell you that this is a very temporary. It's something which will happen. It's a cyclical, it will always happen. And if you give the reasons, as I've told you, someone knows that this is not a problem. And that bank is also a bank that is a domestically systemic financial institution. Is a bank that has the support of the government. We have very strong shareholders. So we got a very good rating, and I can assure you that it is going to help us in growing our balance sheet is also going to give us, it has also given us a lot of comfort in terms of the way the international bank, other international multilateral institutions perceive the bank, but also we will be able to open accounts for some of the institutions that cannot open an account with a non-rated bank. Now, the only rated institutions in the country could have been those who are subsidiaries of Standard Chartered, Barclays, because they are rated international somewhere there. So they have an advantage, of course, but then with this rating, it also gives us more or less an equal footing with our colleagues.
Charles, thank you very much for your time today.
Thank you so much. Thank you.